What are some of the questions I'm asked before someone purchases an annuity? Well, today I'm going to share some of those top questions and the answers so that you can decide if an annuity is right for you. Hi, I'm Charles Cannon, Certified Financial Planner and founder of the Lifetime Income for You channel. If you would like to find out if an annuity would help you protect your retirement, take my Masterclass and apply to become a client. Inside that class, I have 3 great planning tools that you get just for taking the class and applying to become a client. So don't wait, do it today, and live your best retirement. The number one question I get is an annuity safe? Well, I'm going to tell you that it might be the safest place you can put your money. See, every issuing insurance company has to adhere to the rules of legal reserve. Have you ever heard of that? You've probably heard of FDIC. In FDIC, if you put $100,000 on deposit in a bank, do you know what they do the next day? They borrow 9 times that amount from the Fed, and then they loan out the entire $1 million. That's why in 2008, when all the banks were at risk due to the mortgage crisis, we had to do the huge bailout for all those banks. Well, in legal reserve, an insurance company keeps 100% of their obligations in cash at all times. That means that they have all the money they need in cash to pay you everything they owe you, always. And guess what? In the state that you live in, the insurance commissioner is watching that balance sheet at all times. A really good example of this is in 2008. The international conglomerate AIG effectively bankrupted themselves on credit default swaps. But American General Life, their insurance company, was fully protected. In fact, my biggest client family was all American General clients. And when we reviewed their policies, they were all exactly where they should be to the penny, based upon illustrations I had done for them in 1998 through year 2000 when we placed the policies in place. 2008 did not disrupt the growth of their policies at all. And that's due to the walls of protection that legal reserve gives your policies. Also, if you Google legal reserve, I think you'll find that in the Great Depression, when the government didn't print money, it was the cash that the insurance companies had that reopened the banks. So you see, insurance companies are cash rich, and that's what protects you. For all the best on annuities and retirement planning, click below to subscribe to my channel, ring the bell for notifications, and don't forget to hit subscribe. The next big question I get is, what are the fees? Well, every single annuity contract is going to be a little bit different, but generally speaking, an annuity is not a fee contract, it's a spread contract. What does that mean? Well, when you make a deposit into an annuity, your money goes into the bond portfolio of the underlying insurance company. And if we look at their last 5 years, most insurance companies are averaging 5 to 5.5% yield from their portfolios. Guess how they get paid? Well, they keep about half of that for themselves. So if you can imagine that you're an insurance company and you've got a $40 billion bond portfolio, 2 to 2.5% is pretty good, right? The other 2.5 or 3% is what they would offer you in a fixed interest contract. And that's what we're seeing as today's rates in a MIGA, which is a multi-year guarantee annuity. But in a fixed indexed annuity, they take that 2.5 or 3% and they're buying you an option in the underlying index that you've selected. So you pick the index, and if the index goes up for the year, you're going to get a portion of that applied to your contract. And here's the best part. If the index goes down, you don't lose a penny. Why is that? Because the option simply expires valueless and it didn't cost you anything. It doesn't cost the insurance company anything because they paid for that option with the money that would have credited your contract in a fixed rate anyway. If you do have a guaranteed lifetime income annuity, there will be a fee of about 1% for the rider that provides the income. See, the insurance company has to pay itself for that guarantee it's providing you. They're providing you likely a 7% or so roll-up amount on your income base, and then they're going to guarantee a lifetime income when you begin the income stream. But the real good news is it comes off your contract value, which is essentially the death benefit, and it will be paid after your death or after the death of you and your spouse in a joint income annuity. The insurance company has to pay itself for that guarantee that it's providing, and that's fair. The best news is that if your contract value ever gets to zero, the insurance company still pays you your income. And what that really means is that you are in the pocket of the insurance company for the most possible value for that contract. Click below to take my masterclass, and remember, you get to talk directly to me when you apply to become a client, not some nameless, faceless person in a phone center somewhere. I'm Charles Cannon, and remember, the most important part of your retirement is lifetime income for you.